Well, hello, everyone. My name is Brad Etheridge. I'm the Chief Marketing Officer for the Center for Tax Strategies and Resources. Great to have you with us here today. We are just about up to our Academy event, which starts actually on the 22nd through the 24th. I'll fill you in on a little bit on that in a few moments. But it's a big deal, and one of our speakers, Bruce, will be with us for the Academy. For those of you that haven't been on a webinar with us before, you can ask questions during the presentation. We have a staff of folks that are ready to jump in there and answer any questions you might have. What we don't get to, we will certainly ask Bruce to hang around for a couple minutes, and so make sure you stay tuned to the very end, because some of those questions we'll actually answer live. For those of you that don't know much about the Center for Tax Strategies and Resources, we're a membership organization. We're not an IMO, we're not a broker dealer, we don't care where you place your business. The center is all about an education that works with advisors, CPAs, tax attorneys included, financial planners, insurance agents, P&C agents. We train, provide mentorship, collaboration, which is awesome because it really allows you to make your practice larger than it actually is today. So we have a lot of subject matter experts, one of which you're going to hear today in Bruce Givner, the extraordinary tax attorney. We work with you on markets and providing access to these major resources that can help take your practice to the next level, add a couple $100,000 to your practice income. Building these teams using our resources make you much more than you would be alone. We like to say that our members are independent, but they're not alone. This coming up here, the center was created primarily by Simon Singer, who I'm going to tell you about here in just a minute, but he was really looking to accomplish something. Those of you that have been in the industry more than 10, 12 years realize that there really isn't company training being provided. There is no home office expert that's coming back down. You can get some information from a vendor, but usually, an IMO or a PPO or a general agent's just trying to get you to move a specific product. And Simon realized that there was just a huge gap that existed in the industry, and he started the center. So again, education-based, provide a lot of resources, and you get to meet a lot of folks that you can add to your practice that will make you much larger than you would be if you weren't part of the group. About halfway through the presentation, we're going to tell you a little bit more about our virtual academy, which is going to be the 22nd through the 24th. Prior to COVID, did these live, but it's actually been amazing. No TSA, no long lines, no hassles with the hotel. Our virtual academy starts the 22nd to the 24th, which is next Monday. We start at 8 a.m. Pacific. We end at 3 o'clock, or pretty close to 3 o'clock Pacific, based on how many questions come up. And you will have unbelievable content that comes through this. If it doesn't add 50, 60, 70,000 to your practice, we'd be shocked. We have long days with a lot of content. Those of you that register will have access to a recording of the entire event. So if you have to miss an hour or two for a client meeting, no problem. You'll be able to go back and replay it. For more information, you can give us a call at 877-258-2837. Or if you prefer to email, you can email us at thecenterteam@yourctsr.com. We'll tell you a little bit more about this about halfway through. Bruce, when you go to take a break, we'll talk a little bit more about a couple things that are upcoming, and then hand Mike back to you at that point. At this point, I'd like to just do a quick introduction for Simon Singer. For those of you that don't know Simon, he's been successfully in our industry since 1966. He's written 3 business bestsellers, all of which are related to our industry and planning. He's a very sought-after speaker, been a member of some very prestigious groups, including Forum 400, and is the National Humanitarian Award recipient. And my partner in Center for Tax Strategy, Simon, I'll turn it over to you.
Thank you, Bradley. We're going to have some fun today because Bruce Givner is considered the attorney's attorney. Frighteningly bright, very intimidating, also extremely creative, and pays a lot of attention to our industry because he's learned that we help generate revenue for him, and he's been a great teacher and mentor to me in helping generate revenue for me, and we've worked together now for over 30 years. What he's going to talk about today is going to be everything you wanted to know about trusts, but we're afraid to ask. He's also going to share with you a little bit about how learning a little bit about these particular subjects, you don't have to be experts, but can also help you generate a lot of additional revenue for yourself. At the center meeting, he's going to talk about how to reduce or eliminate long-term capital gains on the sale of an appreciated asset, which could be businesses, it could be a portfolio, it could be real estate, any of the above, and generate a significant amount of revenue for yourself. So at this time, please join me in welcoming my friend and my business associate, as I said, for over 30 years, Bruce Givner. Bruce.
Thanks, Stuffy. Pleasure to speak to you all today. First, tell me, can you see my screen okay, Stuffy? And can you hear me okay?
Yes, you can, Bruce.
Okay, terrific. So what I thought we'd talk about today are trusts. And the reason for it is because the word doesn't really tell you anything. When you say you've got a trust, I say it's like saying that you've got a car. If I say I've got a trust, you don't know whether I've got a Volkswagen or a Bentley. And my point to all of you is that if you understand them more, it'll help you deal with some of the deal killers. And who are the deal killers in the industry? CPAs and lawyers. And CPAs don't understand trust, and virtually all lawyers do not understand trusts. And I'd like to delve into that and help you understand the confusion and maybe pierce through the confusion and make you more powerful in the meetings and discussions that you have with the other professionals who should be part of the team, who should be helping you pull together in the best interests of the clients, but usually aren't. Stuffy and I talked about CPA yesterday, who was trying to kill the deal, who was at best unenthusiastic about the plan that Stuffy was presenting to the taxpayer to reduce his taxes. And any event, so we're going to go through misconceptions. We're going to go through aspects of trusts, and starting on page 1. So I say that trusts leave clients, CPAs, and even most lawyers in a state of confusion. And you should know that trusts are virtually unknown throughout the world. They're only known in countries whose laws are based upon medieval England. Our law comes from, and we call it the common law. So countries like Australia, New Zealand, South Africa, a lot of the Caribbean, those are the only countries that have trusts, and we'll go into that a little more. And one of the threshold issues is that a trust is not like a corporation, partnership, or LLC. It is not an entity in many respects. By the way, in the Internal Revenue Code, trusts are treated as entities. But for state law purposes, they really sort of aren't. And it goes to the very fundamental nature of what a trust is. A trust isn't like an LLC. It doesn't sign its own name. Instead, a trust is a relationship that a trustee has to the beneficiary. It's one person holding assets in trust for someone else. And most of the world doesn't understand that. And most professionals don't understand that. So when I say, why do you care? Because if you make your clients comfortable that you understand the concepts, they will be more comfortable that you are a knowledgeable professional. And if you master some of these concepts, you can intimidate the CPAs and other deal breakers. So at the bottom of the first page, these rules do go back to Roman times, but they basically come from medieval England. I'm not going to take you through that, but the basic idea was that people would go on the Crusades. They would leave their properties to be cared for by other people. And when they came back from the Crusades 20 years later, the person they left the property in charge of said, nope, it belongs to me. And the courts in England, there were two kinds of courts, courts at law and courts of equity. The courts of equity said, that's not fair. You were really holding this property in trust for this other person. And that's how trust came into existence. Internationally, if you look, trusts aren't known in virtually the entire world. Now, because of the dominance of the United States after World War II, there became the Hague Convention, which causes most countries to recognize, even though there's only 14 countries that have signed on to the Hague Convention, if you go to countries like Germany and France, they recognize a trust coming into their country, but you wouldn't go to France to set up a trust. So who are the common law countries? So I've got a list here: Australia. You don't think of Barbados and Brunei, but they were based on the common law that we inherited from England. Wales, Hong Kong, India, Malaysia, New Zealand, Northern Ireland, Pakistan. I wouldn't have thought of Pakistan, but it came from India, right? Singapore, South Africa, Sri Lanka, I wouldn't have thought of, but it came from India, okay? So what is the other major legal system? It's the civil law system, which really means the Napoleonic Code. Napoleon had a very large empire, and the Napoleonic Code countries, the civil law countries, don't recognize trust innately. Now, if you come in with a US trust, they will sort of accommodate you, but they don't really recognize them. Then I have a list, just so you're aware, that much of the rest of the world is neither a Napoleonic civil law rule nor the common law. And if you look at this list of countries, you'll see that they're based upon the empires that used to dominate the world. So you'll see a lot of French civil law, Portuguese civil law, because Portugal had a huge empire back in the 15, 16, 1700s. Germanic civil law, any event, just an introduction. Okay, so we talk about a trust. Who are the parties to a trust? Well, the first one, the person who creates the trust, we don't use the word creator. We say under state law that the person is a trustor or a settlor. Settlor meaning the person who settles the trust, creates the trust. The word grantor is a federal tax law rule. It's not a state law rule. So when you read the probate code of any given state, you're not going to see the word grantor. You're going to see trustor or settlor. But if you read the Internal Revenue Code, it's going to talk about grantor. So there's 4 words that you could see. Creator, not going to see that in a state law. Trustor, settlor, state law words. Grantor, federal tax word, okay? Who is the creator setting this up for? It's for the benefit of a beneficiary. There's no synonyms for that word. Next, we get to the other big category, which is you think of as the trustee, but it's really a fiduciary. What the heck does fiduciary mean? It comes from the Latin fidere, which means to trust. It means faithful, which is why dogs used to be named Fido, okay? And what is a fiduciary duty? The best definition that I've ever heard comes from ERISA, the Employee Retirement Income Security Act of 1974. And if you read, I think it's section 3, parenthesis 36, I think that's the section, it says someone who has discretionary authority or control over trust assets. Well, the trustee in a trust is that person who has a fiduciary duty towards the beneficiaries, okay? And what is a fiduciary duty? It's the highest duty that the law imposes on one person for the benefit of another person. So you think of the duty that a spouse has to the other spouse, that parents have to children, that a majority shareholder has to the minority, that an officer has to the shareholders, that the board of directors has to the shareholders. And by the way, that's why corporations that are public go to Delaware, because in Delaware, the fiduciary duty has been weakened. So it's easier for the board of directors to be protected from a shareholder lawsuit in Delaware, meaning the fiduciary duty is less in Delaware than it is in California. The minority shareholder is much more protected. There's a stronger fiduciary duty in California than there is in Delaware. Fiduciary duty is also, of course, what the trustee owes to the beneficiary, but the trustee is not the only fiduciary. when we used to have wills, which we really don't have in California anymore, trust, living trusts, and we're going to talk about the synonyms because living, revocable, family, inter vivos, which just means among the living, those have replaced wills. But when people disposed of their assets with wills, the executor was the fiduciary because the executor owed a fiduciary duty to the beneficiaries of the will. Okay, but a fiduciary isn't, a trustee is not the only fiduciary necessarily in a trust. There's at least a couple of other people who might be fiduciaries. One is someone called a protector. Well, when I started practicing 44 years ago, you didn't see protectors in US based trusts. We borrowed that term from trusts created under the laws of Britain, the United Kingdom. And now they are very common. Mostly when you see a protector in a trust drafted in the United States, that protector is going to be a fiduciary. Why? Because that protector owes a duty to the beneficiaries. And if you read an article by Alexander Bove, B-O-V-E, you will see him constantly talking about a protector as a fiduciary. However, I can tell you in our firm, when we use a protector, the protector is not a fiduciary. Why? Because we give the protector powers to do very bad things as to the beneficiaries. We give the protector the power to remove a beneficiary. Well, if the protector has the power to remove a beneficiary, the protector can't be acting in a fiduciary duty because that's against the beneficiary's best interest. We give the protector the power to add a beneficiary. We give the protector the power to change the allocation among the beneficiaries. Let's say there's 3 children, and the initial way the trust is drafted is a third, a third, a third. Well, the protector has the power to make it 45, 45, 10. And we give the protector the power to change the manner of distribution. Let's say when the trust is first established, the children get their shares a third at 25, 30, and 35. 20 years later, the parent says, hey, that's too soon, and the protector changes it to a third at 40, 50, and 60. So when we draft the protector provisions, we make it clear the protector is not a fiduciary. Why? Because when we do it, the protector is really the agent for the parent to retain dictatorial control over the trust. If you haven't seen it, send me an email and I will send you a copy of our handout entitled Maintaining Dictatorial Control Using a Children's Trust. And the protector is arguably the most powerful way the parent maintains dictatorial control over the children's trust. And by the way, we don't have the parent name a protector. What it provides is that if the parent ever wants a protector, the parent's then CPA will appoint a protector. And once the protector takes the action that the parent wants done, the protector immediately resigns, so we don't have anyone hanging around with powers over the trust. So you got the trustee, you've got the protector who might be a fiduciary, not in our documents. Another person that might be a fiduciary is a manager of a single member LLC owned by the trust. When does that come up? Well, it comes up in at least 2 different situations in our practice. One is when we set up an asset protection trust under the laws of, let's say, Nevada or South Dakota. There's 14 other states with asset protection trust laws, but we typically use South Dakota or Nevada because we think they have the best laws. Why best? Why are those 2 the best? Because they both have 2-year statutes of limitation on fraudulent transfer actions, meaning if you set up one, someone has to sue within 2 years claiming that it was a fraudulent transfer. And the other reason is because they have no what are called exception creditors. If you look in states like Delaware or Ohio, if there's a child support order or a spousal support order, those orders can reach inside the asset protection trust. Not so in South Dakota or Nevada. If there's a child support order, it can't get in the Nevada or South Dakota trust. By the way, the US government is always an exception creditor. So when we set up an asset protection trust, what we do, because the trustees charge a fee for controlling trust assets, is we just give the trustee a bank account with $10,000 or $20,000 in it. And all the other assets are in a single member LLC, of which the trust is the sole member. And it could be that the client is the manager. Although if there's any problems, we don't want the client to be the manager. So typically we'll have child, best friend, CPA, business colleague, relative as the manager of the single member LLC. Well, that person has discretionary authority or control over trust assets. So the manager of the single member LLC is a fiduciary. One other situation in which we have a single member LLC owned by a trust. For distributions to children, on the one hand, the client says, you know, I want the children to get everything outright the minute I'm dead. And we say to them, you know, if you leave the assets in a trust for the children, and the trustee has complete discretion whether or not to make distributions, the child gets the highest level of creditor protection they can get under the law. That's true even in California, which doesn't have great creditor protection rules otherwise. And they say, yeah, I like that, but I really want the children to get the money. So we have sort of an in-between disposition method, which we refer to as the beneficiary controlled trust. What happens is the parents name an independent third party as the trustee. But we suggest to the trustee in the trust instrument that the trustee contribute the assets for that child's trust down into a single member LLC and name the child as the manager of the single member LLC. Well, as long as the child's doing a good job, okay, by the way, the child can take a fee for managing the LLC, then the trustee leaves the child in as manager. But if something goes wrong, meaning the child gets sued, or the child invests 100% of the money in the LLC in some inappropriate fashion, the trustee removes the child as manager, okay? But we give the child the power to remove the trustee and name a new one, as long as the new trustee has, make up a number, a minimum of $5 billion of assets under management. In other words, we don't want the child to be able to remove the trustee the parents selected and just put in the child's best friend. So I'm done. I just wanted to say that there are other situations in which there can be a fiduciary besides the trustee. Okay, so we talked about who are the parties. Now let's talk about when is a trust created? And the answer is there are two possibilities. One is a living trust, and the other is not a dead trust, but a trust that's created by a testamentary document, okay? So a testament is defined as a document that springs into existence at death. Call it post-mortem. So most trusts that we're going to run across, I'm not even sure that's true, but a lot of trusts, how about that we run across are going to be living trusts. Inter vivos, inter means among, vivos the living. So our living, inter vivos, revocable, family trusts, which the parents set up, of course, to avoid the fees of probate, to avoid the delays of probate, to avoid the publicity of probate, because probate is a public process. You can go down to the courthouse and pull all the records. And at least in California, prior to about 1975, most estates were disposed of by means of wills. Starting at about 1975, living trust took over, and by the 1980s, most people with any wealth disposed of their assets using a living trust. And that's mostly what we see, living trust, and I mean revocable living trust. However, in estate tax planning, most of the living trusts are irrevocable living trusts. Why? Because we're setting up, for example, an ILIT, an irrevocable insurance trust, to do some estate tax planning. Now, by the way, when you call it an ILIT, it's really a meaningful, a meaningless description, because an irrevocable trust can be created to own an insurance policy. It can be created to own a membership interest in an LLC, to own an interest in a family limited partnership, to own non-voting stock in an S corporation, and it can be created to do all of those things. When you call it an ILIT, it doesn't prevent it from owning non-voting stock in the family S corporation, or from owning limited partnership interest in the family limited partnership. So when you call it an ILIT, it doesn't really mean anything. I mean, it can do all those other things too. And by the way, if you set up a children's trust to be a partner in a family limited partnership, it can also be an ILIT. So it's not like an ILIT is any particularly meaningful description of an irrevocable trust, because the children's trust we set up to be a limited partner in the family limited partnership has all the same boilerplate as the ILIT, okay? So there's living revocable trust and there's living irrevocable trust. Now, a testamentary trust, when do you see those? Well, typically it's going to be from the living trust created upon the death of the first spouse. So let's say the parents have a $20 million community property estate. Dad dies first. His half, his 10 million, is going to spring into existence in an irrevocable trust, which will be the bypass trust, typically, okay? Because that's less than the amount of his lifetime exclusion, which in 2021 is $11,700,000. But it doesn't have to be. It could be that it goes into a marital trust, and mom, gets the benefit of his exclusion under portability. We don't have to go into that right now. This is not a discussion of estate tax planning. The point is just that it's a trust created by the testament, which is the living trust, okay? And we're not dealing with the estate taxes yet. Okay, so that's when created. Now, how created? Oh, well, that's sort of interesting. There's more than one way to create a trust. So here's the California Probate Code. There's nothing particularly unique about the California Probate Code. It's based upon the Uniform Trust Code, which most states have adopted. The code sections in each state may be slightly different, but the language is basically the same. So we start with 15200A. It says a trust may be created by a declaration. Well, a declaration is a statement. It doesn't necessarily have to be in writing. A declaration by the owner of the property that the owner holds the property as trustee. Well, in 1993, the Hegstadt case was decided in California, and it was basically a revolution. Prior to Hegstadt, I started practicing in 1977. I think we charged $2,500 for a living trust. We don't charge a whole lot more than that today, but we had a paralegal, and what she did was transfer assets to the parents' names as trustees of the living trust. So we might charge $2,500 for the living trust, but there might be $1,000 of paralegal time meticulously transferring all the assets to their names as trustees of the family trust. All of a sudden, the Hegstadt case came down and it said, all you have to do is declare that you're holding all the assets as trustees of the trust. That's all you have to do. By the way, in 1996, there was another case called Oswald versus Anderson, and it said, however, if you've got real estate, you have to do the declaration in writing, and in that writing, you have to identify the real estate by assessor's parcel number, legal description, or address. And that's due to something called the statute of frauds, which says anything dealing with real estate has to be in writing. So The Hegstadt case and the second case got rid of the need to meticulously change title to all of the assets. Because with the blanket assignment of assets, if the parents died, you file a petition with the probate court, don't have to show up in the probate court for $2 or $3 grand. All the assets are trust assets. So when you've got people in their 40s, 50s, 60s, even 70s, why bother meticulously changing title to all the assets? The blanket assignment does it for you. And people who are in their 60s, do you really believe they're going to own those assets when they die at 87 or whatever age they might die at? So that's an oral declaration.
Well, Bruce, I'll give you this opportunity to grab a drink of water. I'd like you to come with me on every single presentation I do for the next 10, 12 years, if that's possible. A lot of that stuff, it's the first time I understand it. Okay, as promised, I want to tell you a little bit about the organization here and give Bruce a chance to catch his breath. If you want to get better, you need coaches and you need mentors, and that is part of our every other professional athlete and everyone else in the world, politicians, business people, all have them, and it seems like folks in our industry just don't. You need coaches and mentors to get your practice to the next level, to have access to people like Bruce, and Simon that can demystify the complicated. Give you a little snapshot here of what's coming up with our faculty for the upcoming academy. We've got just a really diverse group of folks that are all talking about things that can add to your practice income, and solutions for your clients. Bruce Givner, who you're hearing now, of course, is nationally recognized tax attorney. Kevin Knebel, who is the #1 most sought after business speaker in the US right now. His label has a lot to do with making LinkedIn work for your practice, but in reality, he's just has a huge understanding about how people think and how to create new relationships that can add to your prospecting. Joe Struzzari, who's a nationally recognized tax attorney and creator of the Southern California Laureate Program, which is a think tank for CPAs and attorneys. Joe's amazing, and he talks about business transition. He talks about all kinds of strategies that can eliminate unnecessary taxes for the clients and help protect assets. Simon Singer, who we talked about before. We've got Joe Campo, who's a defense attorney. It's going to be kind of an interesting conversation talking about things that can get you in trouble in the industry. A lot of you know Curtis Cloak. We've had him on our dais more than once. Preeminent expert maximizing retirement cash flow. We've got Walt Dallas, who is another tax attorney, and his practice focuses on reviewing existing tax returns for business owners and showing them incredible efficiencies. It's one of the services our members have access to. Harold Dilemma, who's Senior Vice President of Financial of FIG Insurance Group, master understanding of the annuity segments. Jason Kirchner, founder of Sage Consulting, is going to talk about quite a few things, including referrals. Jerry Minardi, who's the co-founder and managing partner of Selling Technologies. He does video vignettes, all professionally produced, that you can send out to your existing clients or to prospective clients that are all on all kinds of subject matters related to financial services. David Nesty is the chairman emeritus of Prager Metis, huge accounting firm, is going to talk about some business issues that are coming up in the tax law changes. Mark Pace, national expert in life insurance. Steve Pasek, EPA, Masters of Taxation, another one of the firms that we use for our members to review existing cases. Dr. Vicki Rackner, one of our favorite all-time folks here with the center. She's on the advisory board of the Doctors Academy of Economics. She's going to talk about adding doctor clients to your practice. Daniel Zeppelin, who has a very unique senior settlement protocol that he does, and basically he's taking those policies to auction on a very open format. So we've had some amazing results with all these folks. Again, you're going to get access to people like Mr. Givner here. You can learn more about us. You want to attend this academy. It's March 22nd, 24, which is next Monday. So it's Monday, Tuesday, and Wednesday, 8 a.m. Pacific to 3 p.m. Pacific. More information, or if you just want to find out more about the center, go ahead and give us a call, 877-258-2837. Or you can email us at thecenterteam@yourctsr.com. And keep those questions coming in, and we certainly will address those at the end. And Bruce, I will turn that back over to you now for control.
Thank you very much. I'm going to go to the bottom of page 7, and talk about another way to create a trust. I think although I mentioned it, which is a declaration. So in the California statute, it says an enforceable promise to create a trust. Why is this helpful? And the answer is this situation arises all the time. We get a call from the client. The client says, I'm getting an insurance policy. The insurance agent wants the trust to be the applicant for the policy. Can you prepare it for me this week? And the client's calling on Thursday. And my answer is, no, of course I can't get prepared this week. So how does the oral declaration of a trust help? The answer is I say to the client, what's the name of the trust going to be? And the client says, well, it's going to be, because the policy's on me, the Joe Smith Insurance Trust. Great. Who's the trustee going to be? And I can tell you in our firm, we don't like the client to be the trustee. We don't want the client, now when it's after they're gone, we don't want them to name all the children as co-trustees because we think that leads to problems. We don't want them after they're gone to name a child as trustee over the other children because we think that's going to lead to problems. However, when they're alive, if they want to have a child as trustee, that's fine. The child's going to do whatever they tell him to do, because if the child doesn't, they can disinherit the child. So let's say they say it'll be Michael Smith, comma, trustee, comma, of the Joe Smith Insurance Trust. I say, great. And I send a confirming email, and they have Michael Smith, trustee of the Joe Smith Insurance Trust, sign the insurance application. And let's say it takes us 2 weeks to prepare the written trust. When we do the written trust, it starts off by saying, this is to memorialize the prior oral trust, which began on March 18th, 2021. So you can create an oral trust as long as it's not for real estate, and later replace that oral trust with the written trust instrument. So this eliminates all the problem of the time pressure of creating this insurance trust so you can sign the application. So it's very helpful. Let's go on to what are the requirements for a trust. Now this is in the middle of page 8. So one thing you've got to have is the intent to create a trust. You have to have an asset. Corpus means body. You've got to have an asset, and you've got to have a beneficiary. One thing that's required, implied, is that you have to have delivery to the beneficiary. And when you have a corpus, it means you've got to have someone holding that asset, which means a trustee. So even though it says these 3 things, there's 2 other things that are implied by those 3 requirements. To have a corpus, you've got to hand that corpus to the trustee. To have a beneficiary, you've got to have delivery either to the beneficiary or to the trustee. So let's move on. We're going to start getting to the more complicated stuff. So who is the beneficiary of this trust that you've created? Well, can the person who creates the trust also be the beneficiary? Very interesting question. And this is called the rule against self-settled spendthrift trust. What the heck is a self-settled spendthrift trust? Well, self-settled means I create it myself. So self-settled, I'm the settlor, I create it myself. Spendthrift means it's protected from my creditors, and what's implied is that I'm the beneficiary. Well, that's been against the law for about 800 years, meaning dating back to medieval England. And the reason why it's been against the law is for the same policy reason that we have the fraudulent transfer law, which in California has now been replaced by the Uniform Voidable Transactions Act. But the Uniform Voidable Transactions Act basically means the same thing. I mean, there's some tweaks to it as the Fraudulent Transfer Act. And both the Fraudulent Transfer Act and the rule against self-settled spendthrift trusts, which both date to Roman times, but were clearly ensconced in medieval English law, are based on unfairness. If you and I enter into a contract and I welch on the contract and you come to collect and I immediately start transferring my assets to my children, to my best friend, to my niece and nephew. That's just unfair. And that's what a fraudulent transfer is. And if I set up a trust for myself with my own assets and protect it from my creditors, that's unfair. So it's the same kind of rule. So historically, what happened is in the 1950s, 3 islands off the coast of the UK, Jersey, Guernsey, and Man, repealed the rule against self-settled spendthrift trusts. So people from all over the world went there, set up trusts to be protected from their own creditors. And then in the 60s, islands in the Caribbean and Bermuda, which is not in the Caribbean, it's off the coast of North Carolina, also repealed the rule against self-settled spendthrift trusts. And you saw people from the US setting up trusts down there. The modern world began in 1989. Barry Engel, a lawyer from Colorado, the late, great Barry Engel, I must say, was hired by the Cook Islands to rewrite their 1984 trust law. And the 1989 law became the model of offshore asset protection laws. It was adopted in many other countries who updated their laws to reflect the Cook Islands laws. And in 1989, Jonathan Blattmacher went to Alaska, set up a trust company for his brother, and rewrote the law of Alaska, which repealed its rule against self-settled spendthrift trusts. Well, Alaska is a very unimportant state. But the same year, Delaware, the most important state in the country, and Nevada, the most important state for California, also repealed the rules against self-settled spendthrift trusts. And in the remaining 32 or the 32 years since '89, another 13 states have repealed that rule. By the way, the question is, if a California person sets up a Nevada Asset Protection Trust and gets sued in California, does the Nevada Asset Protection Trust work for the California person? And the answer is, no one knows. It's still not been litigated. In June of 2019, the in re, which means in the matter of, Cleopatra Cameron Gift Trust was litigated in the South Dakota Supreme Court. And the South Dakota Supreme Court said, we will not enforce the California family law order against our South Dakota trust. Will that make it to the US Supreme Court? Maybe not that case, but there's going to be a case that's going to make it to the US Supreme Court where they're going to tell us whether the Asset Protection Trust court has to give full faith and credit to the debtor's home state judgment. And we don't know yet. There is a divorce coming out of Texas called Ed and Marie Borsage, B as in boy, O-R-S-A-G-E, which has a good possibility of making it to the US Supreme Court, since Marie accuses Ed of putting $2 billion into a group of offshore and South Dakota trusts, and she's been unable to get any of it. Ed, of course, at 78, obviously what do 78-year-olds do? They take up with 30-year-old women. And Marie's unhappy with that. I can't imagine why. So that's, who's the beneficiary? Can it be the grantor? The answer is, the law is not supposed to work that way. What about a third party? Well, the grantor's spouse. Usually we put in something called the floating spouse definition, which is the person to whom the client was married at that time, neither being under, both having lived together as husband and wife at the time, neither having filed for divorce, annulment, separation. Recent case, I don't know how to pronounce that, Oaksey or Oaksey versus Oaksey in Texas. And without going into the details, just say, you need to draft that very carefully. Because in that case, it was a lawsuit between wife number one and wife number two. And I think wife number one won, even though I think the intent was to benefit wife number two because it was a floating spouse definition. So obviously, the grantor's children are typically the beneficiaries. One of my colleagues, Glenn Alperstein, who I think is retired, over 20 years ago in his living trust, which ran 180 pages long, had 10 pages devoted to advances in fertility treatments to deal with who might be a child of the decedent. And then, of course, what do you do when you have an unknown at the time the trust was drafted, child of the decedent? That's come up in my practice 2 times in the past 3 years. Both children born in China, and the question was, could we identify them? And then you've got the whole process of disinherited children. And the problem with that and no contest clauses is that, at least in California, no contest clauses are against public policy. Can you set up a trust to benefit an animal? Well, 10 years ago, it wasn't so clear. Now, California at least allows pet trust specifically. Can you set up a trust to benefit charity? Of course. Can you set up a trust to benefit no one? Wow. Well, now in some states, California not one of them, you can set up a purpose trust, which doesn't have to be for a charity. I've never done one, but in some states they allow it. Can you set up a trust to benefit a for-profit corporation? I've never done one, but in some states you can. Okay, now we get to the real, thick part of this topic for you guys and ladies, which is taxation, okay? So the introduction to this topic is that the Internal Revenue Code is not one body of law. It is at least 2 bodies of law. The first part is Chapter 1 of the Internal Revenue Code, which is the income tax laws. The second part is chapters 11, 12, 13, and 14, which we call the transfer tax laws. Chapter 11 is the estate tax. Chapter 12 is the gift tax. Chapter 13 is the generation skipping transfer tax. And Chapter 14 are the special valuation rules added in 1989, again that year, which gave us Cuperts and Gratz, okay? So the problem is people don't understand there's 2 bodies of law in the Internal Revenue Code. So what happens is the word own, O-W-N, means different things in the income tax rules than it does in the transfer tax rules. And you've got to understand that it means different things in the 2 bodies of law. So you end up with this thing which people call, and I hate this term, they call it an intentionally defective grant or trust. There's no such thing as a defective grant or trust. It's either a grant or trust or it's not. There's nothing defective about it. So what you end up with is the CPA saying to my client 2 days ago, if it's an irrevocable trust, it must be a separate taxpayer. And the answer is no. The Internal Revenue Code has no prejudices whatsoever as to whether an irrevocable trust is either disregarded or a separate taxpayer. The Internal Revenue Code doesn't care. It can either be disregarded, a grantor trust, which people call intentionally defective grantor trust. It can either be a grantor trust or it can be a complex trust. The Internal Revenue Code couldn't care less. You simply pick what you want it to be. And if it's an irrevocable trust, the Internal Revenue Code doesn't care whether it's included in the grantor's estate or excluded from the grantor's estate. You pick. The Internal Revenue Code doesn't care. There's no prejudice in the Internal Revenue Code. Okay, so you have these 2 possibilities. For income taxes, it's either tax to the grantor or complex. Now, by the way, tax to the grantor, there can be the beneficiary treated as the grantor. So there's really 2 types of grantor trusts. The second one is called a 678 trust, where it's taxed to the beneficiary as if the beneficiary were a grantor. And then you've got a complex trust, but there's also a simple trust where all the income is distributed to the beneficiary. So it's really more than just one side over here. You got a grantor trust tax to the beneficiary, that's the 678 trust, a complex trust, and a simple trust. And a complex trust could be a QSST, could be an well, a QSST is more like a simple trust, an ESBT. So you have 4 possibilities over here. And on this side, you've got the trust that's either included in the grantor's estate or it's not. So if you have 4 possibilities over here and 2 possibilities over here, there's 8 possibilities. So if you only make 2 possibilities over here, make it simpler, it's either a grantor trust or it's a complex trust. 2 times 2 is 4. Well, you can have a trust that's a grantor trust that's included in the estate and a grantor trust that's excluded from the estate. And believe me, the CPAs don't understand that. And believe me, the lawyers don't understand that. And you can have a trust, which is a complex trust, which is either included in the estate or excluded from the estate. There's no chance the CPAs and the lawyers understand that. They think that if it's I guarantee you, they think that if it's a complex trust, files its own return, that it's excluded from the estate. I guarantee you they think that. And it's not clear at all. You have to read the damn trust. You can have a complex trust. It files its own returns and it's included in the grantor's estate. What? Yes, it's called an incomplete gift trust. Complex trust, incomplete gift included in the grantor's estate, meaning there's a step up in basis. So if there's nothing else you take from this presentation, then that there's two bodies of law, and an irrevocable trust can either be included or excluded, completely independent of the income tax consequences, which is it can be disregarded or complex trust. You will understand the basic, because that is the basic confusion. People think that if the trust is taxed to the grantor, it must be included in the grantor's estate, and that is just not true. It can be taxed to the grantor and excluded from estate. It can be taxed to the grantor and included in the estate. And the obvious example of tax to the grantor included in the estate is a revocable trust. But there are irrevocable trusts that are taxed to the grantor and included in his estate also. So I can say by a show of hands, how many people understand it? But that is the gist of it that we're trying for you to get, okay? So we can sort of stop now without going through all the 2036, 2038 stuff and the creditor protection, because I think, Brad, there's other stuff you want to cover. Is that right?
Well, and I know we told you we'd be about an hour, and I don't want to abuse your time too much. That was incredibly helpful. And what's amazing to me is after all the years of doing this, Bruce, you still jump in there with passion and fascination in regards to people's lack of understanding on some of these things. It is complicated. It's not what we do every day, but it certainly is nice to have a resource like you to explain these things. Because what the clients don't understand, they don't buy. We know that.
Well, let me also share with you that there have been situations most times where a client has their own attorney, and their own attorney feels far superior to people like us, whether they are or whether they aren't. When I mentioned, would you be willing to work in joint engagement with a Bruce Givner, the temperature in the room changes dramatically. He is looked up to, we are looked down to. So give that some thought.
Absolutely. Okay, Todd, if you want to.
Thank you for the opportunity, Brad, and thank you for the opportunity, Simon.
Yeah, sure. We're so happy to be able to spend time with you. I think Todd's taking control back. Let's talk about what's coming up here, and then we've got just a couple questions, Bruce, because you did too good of a job of explaining it. You didn't create any gray areas. So I want to just let everybody know here a little bit about the academy that's coming up on the 22nd through the 24th. These are 18 takeaways. There will be much more than 18, but they're the 18 that we will make sure we cover in that 3-day period. We'll talk about how to reduce taxes in order to create clients. Great way to open up new relationships, of course. We'll show you how you can use hardwired tax reduction plans prepared by experts to get you in front of enough of the right kind of client. 3 ways to take over existing retirement plans that produce assets under management and create large insurance sales. We'll talk about the best comparison of term versus permanent, give you a little bit of a hint. It's permanent. Retirement plan that provides more retirement income than defined benefit plans and is tax-free. We'll talk about retirement plans that provide health benefits that are tax deductible and tax-free. It's a very popular topic. A lead system that not only tells you who has retirement plans, basically meaning corporate plans, how much is in them, what the current yield is, what they're paying in fees, whether or not the yield and fees are in line with the industry or geographic areas. We'll show you how to use that tool. We'll talk about marketing with customized short video vignettes that are professionally produced, digital content marketing that's all pre-populated and done for you. So it's plug and play. You turn in the leads and it starts to send out the information to those prospects. A computer system that tells you which assets to access, in what amount, and at what time, in order to maximize your income. We call that combining timing and sequencing. We'll show you how that works. Exit strategies for qualified plans that reduce income or estate taxes. We'll talk about defined benefit retirement plans that create huge guaranteed income. We'll talk about how to get doctors or dentists as your A clients. Talk about the pros and cons of those doctors, what it's like working with them, and we'll have an expert for you to get that perspective. A strategic partnership with CPA firms and property and casualty agencies that can really increase your prospect list. 5 ways to convert IRAs, profit sharing, 401k plans, defined benefit plans to Roth for your clients. Plans to stay away from. Big section, we'll spend a lot of time on that, of things that can get you in trouble, because there is no reason for that if you're prepared. Expert resources to help educate you on sophisticated strategies, orchestrate engagements, and close business, demystifying the buying process. And we'll talk about the Southern California Institute education and presentation. And again, as I mentioned earlier, we'll have Joe Strazzeri, the founder of SCI, on with us for the program. So if you want to get the cliff notes to what would take you probably 25 years if you could find the experts, and if you want to read the cliff notes and figure out how to expand your business, come on to the Center's Virtual Academy this Monday, March 22nd through 24th, 8 a.m. until 3 p.m. Pacific. Again, we stay pretty close to the time. To register, go to our website, www.yourctsr.com, and there's a tab on there that says upcoming events. There's also some other information you might find really interesting on the site. It's $545 for the tuition to attend the academy. The first 20 that register will get $75 off.
Brad,
Yep.
it's not 20, it's 11.
All right, the next 11 people that register, thanks, Simon, will get $75 off if you enter the name Bruce, and it is case specific, so capital B, small UCE, RUCE. Enter that in the promo box, and that'll save you $75. If you want just more information on the center or what we could do or what it takes to qualify to become part of our group, or you want to find out more about the academy or any other general questions, give us a call at 877-258-2837, or you can email us at thecenterteam@yourctsr.com. So hope to see you here at the center. It's an amazing 3 days. So do what you can and figure out how to get there. We'd love to have you.
You got
Okay.
questions, Bradley?
Yeah, I think we did. Let me get to the ones, Bruce, a lot of them we can answer because I had some notes from you in advance. Bruce, what's your thought on perspective section 2901?
I'm not sure that I've read it enough to make any comments, Brad, at this time. I mean, I can talk about changes in the law that have been proposed generally, but I'm not sure I know enough about 2901. We are doing a seminar on all of the proposed Biden tax plans, which I'm glad to send you an invitation to, which everybody can attend if you want them to, or I can do one for you on all of the proposed tax planning, because the basic pitch is going to be get the clients in now in 2021. You know, it's unlikely any tax law changes are going to pass in 2021, but there's an increasing likelihood they would pass in 2022 or 2023, and you have a much better chance to close the planning for smart people in 2021. And a lot of those solutions are life insurance, because life insurance is one of the only 4 tax shelters there are in the Internal Revenue Code. The other 3 are charitable remainder trusts, charities, and pension plans. And life insurance, the advantage of one of the advantages of life insurance is there's no limit on the amount of assets you can shove in an insurance policy. What most people don't know how to do, which I know how to do, is how to get non-cash assets into an insurance policy. So if you want to get an apartment building in an insurance policy, I know how to do that. If you want to get you know, the assets on the sale of a business before it's sold into an insurance policy, I know how to do that, and I can make you a lot of money for the next 65 years on the trail commission of the use of an insurance policy in the sale of a business. It's a lot easier to sell an insurance policy when the parent is going to save 33.3% on the proceeds of the sale of a business. It's a lot easier than to sell you know, an estate tax motivated insurance policy.
Well, and Bruce, and you can also eliminate the growth on their investment assets. It can be real estate, it can be business, et cetera, et cetera.
And
You know,
all income taxes are gone. Doesn't matter whether you borrow it out of the policy, whether there's a death. So it's difficult to beat life insurance. People do not understand how powerful life insurance is. And
well, it's one of the first sections of the code.
it's 101. Yep.
Yeah.
So
That was it. That was it for the questions. The other ones we actually were able to handle, Bruce, with the notes that you had sent me in advance. So I think we're good there. I thank you so much. This just helps. I can't wait to actually replay this. But I've got such a better understanding now. I appreciate you taking the time to share with everybody.
Thanks, Bruce. Really appreciate it, guys. Gals, hope to see you on the screen starting next Monday. We're getting close, so set the time aside because I don't think you're going to attend another meeting that could easily double your revenue in the next 12 months. So hopefully we'll see you. Brad, thanks for your help. Bruce, as always, thank you, my friend. Talk to you all soon.
thank you.